Hello and welcome to Joe and Paul's Another Mining Podcast. With me, your host, Paul Harris, America's editor at Mining Journal, and Joe Mazumdar, editor of Exploration Insights. Hi, Joe. How are you?
How's it going, Paul? Nice to see you again.
Likewise, have you recovered from the Precious Metal Summit?
Oh yeah, well and truly, well and truly. Thank you.
Excellent. Well, today we have a very special guest, Tom Brady, who is mineral economist, who is currently the executive director of the J.P. Morgan Center of Commodities at the University of Colorado in Boulder. He's also a contributor to Capital Light Research that produces the weekly gold monitor with Markin Marumbel. Tom was also previously chief economist for Newmont. Hi, Tom. How are you?
Hello, Paul. Thanks for having me on today. Appreciate it. Good to see you again, Joe.
Hey, Tom. Yeah, Tom. I mean, just to give our viewers a bit of a background, like we're right now, a couple of weeks ago, I guess, BlackRock manager, a portfolio manager there, was talking about having significant exposure to gold and now greatly reducing that to almost zero. Last week, we had the Fed basically saying that the asset purchases are going to start tapering now in November. We've seen an impact on equities, and in the background, we're seeing a middling impact on the U.S. dollar, with the potential of rising rates, higher inflation, transient or not. And then basically the equity markets seem to be rolling around, albeit at a slower pace, but in reduced volatility. So background, gold was at all-time peak last summer. Now it's trading at 1750, which is still pretty good in terms of where gold companies are looking at reserves. So give us a bit of background for us and our viewers. What do you think drove the gold price up to that level, and probably what brought it back down to 1750?
Yeah, so the more of that downward trend over the last 13 months or so, since last August, interest rates, so real interest rates in particular, is a factor in that. So as an investment vehicle, gold does not offer a dividend or interest rate. And as such, when you start to see higher interest rates, or the possibility of higher interest rates in the future, you're going to see some of that investment demand leaving gold and going into other types of assets where you get that kind of interest rate return or a dividend return. So safe haven investing pulling out of gold. Likewise, the dollar, gold price is inversely related to the US dollar. And so when you see a weakening of the dollar, that's going to be positive for gold. But like on the opposite side, if you see a strengthening of the dollar, you're going to see some downward pressure on the price of gold.
So before we saw competition in terms of maybe potentially safe haven asset or alternative assets between gold and cryptocurrencies, but lately we've been seeing a crackdown on cryptocurrencies in China because of power draws. Some of that's related to that, and also I believe it was Costa Rica that tried to put cryptocurrency as
El Salvador.
El Salvador, yeah, Central American country, and that didn't turn out so well. So going forward, does the pull on demand on gold as for everything that gold offers are going to be reduced going forward from demand for cryptocurrencies, or is the cryptocurrency thing, like, going forward always going to be in competition with gold?
So the Capital Light research team did an analysis in Q1 of this year to analyze what were the drivers behind the gold price drop that declined by over 10%. Bitcoin at that time was up by 70%. So there was lots of news articles. Wow, is Bitcoin, cryptocurrencies, are they siphoning off investment demand for gold? And the analysis we did, what really drove the primary driver of that was again a climb in real interest rates, and which equated to approximately half of that gold price drop. Um, the U.S. dollar increasing by nearly 4%, so that was also a driver. But Bitcoin, we did see that demand was a little over approximately 2% of that decline. So yes, it did factor into that um, price drop that we saw in Q1. And from an economist point of view, I really view that Bitcoin at this point, it's incredibly volatile. It's a speculative asset. If you think about, I always like to use when I'm talking about cryptocurrencies, and if you think about Visa, on every second of the day, Visa can process, um, nearly 10,000 transactions a second. Other companies like Western Union, that does a lot of transfers, they can do about 700 transactions a second. Bitcoin can do 7. And that's just because of the background blockchain technology, where that distributed ledger. It's just very, very time intensive for that to occur. So, you roll that all together, and really that medium of exchange element of uh, of money is not really prevalent with Bitcoin, as many of the proponents would like to see it. Particularly in El Salvador, when they launched their Santoshi currency over the last couple of weeks. That it's just they were demanding that the companies down there just accept Bitcoin as a form of currency. So I just really view that this is it's a speculative asset at this point, and I've done some research over particularly a few years ago, and I'm not a crypto expert, but I come from just an economist point of view. What's really driving this? It's that the store of value piece of money, it's not there because it's too volatile. So, yeah, put a little bit of your retirement portfolio into a cryptocurrency, but I wouldn't put a whole bunch into it because it's pretty volatile. So
Well, I think some of what you just said is summed up by the fact that gold is pretty much labeled a hard asset, and I don't think you can ever describe crypto as a hard asset for that reason. And a good friend of mine, Matt Yuki, wrote an article recently in the Guardian, the UK Guardian, about El Salvador's going crypto, and he was in country. He said you'd be at the surf shack, and if you want to buy a Coca-Cola or something like that, it's and 20,000th bit of a Bitcoin that the woman's got a little machine for. It all sounds a little bit ridiculous.
yeah, yeah. I mean, just with that kind of volatility, you think you're selling something for a certain amount, and then by the time that transaction happens, it might be radically different from that. So as a
So I guess
business owner,
Bitcoin and the cryptos are not going to compete potentially in the future or now with gold as a part of your reserve base. Like we were talking like offline about, the US having over 70% of its reserve base in gold, which is an anomaly among most countries. I think Germany is high as well, but nowhere near the States. But then when we look at the second largest economy, China, I think we were talking that China's got 5% or 6% of its reserves in gold. Do you think that will ever change?
yeah, and again, when I was as the chief economist, I used to really monitor how often China would report their gold reserves to the IMF, as most central banks around the world do. It's usually reported on a monthly basis, but China would maybe report every 5 years. And they are buyers, since 2009. Their central banks in aggregate around the globe have been buyers of gold. And that's primarily been China, Russia, and the stands like Kazakhstan. Why would they be doing that? It's an attempt to diversify their reserves, from the U.S. dollar as well as the euro. Do I see China getting as high as 80%? That's a pretty aggressive. So far that trend has not been, it's marginally increasing when they do report, but at 5%, that would have to be a very considerable amount of gold that they would have to be acquiring. So
Even to get to 10% would be significant.
yeah, right,
Yeah.
right.
But in terms of their eventual goal to make their currency a global currency, do you think that they would need to have more gold backing it? Like we have more gold obviously backing the US dollar, and we have more gold obviously backing, the European countries.
Well, I think right now, for it to become more of a global currency, I think investors need to know that currency is free from manipulation. And over the years, there's lots of discussion that that the China does manipulate its currency through its through interest rates and whatnot, and trading in a particular range. So should the should the Chinese uh, renminbi be higher? Should it appreciate relative to the dollar? It most definitely should, but um, I just think that manipulation factor is prevalent with the Chinese renminbi. So that would that's probably the primary reason why it's not on it is not on the par of the U.S. dollar and the euro in terms of the global currency.
Well, I mean, like we're talking, like, I mean, China obviously tries to keep its currency low because it exports. It's basically export-driven economy, which might change later. But then its issue is that you keep your exchange rate low, so to make your goods cheaper, which helps other countries, I guess. But if they actually raise their currency, then we would see potentially even more inflation than we're seeing now. And then the question is right now is that, is does gold play a role anymore with inflation, like as a hedge against inflation? Do you see gold being in demand as an inflation hedge?
That's again, there's been lots of articles and research done over the years. Is gold an inflation hedge? And some of the just again, we haven't done extensive uh, articles recently at Capital Light, but one's just a simple. You just take the gold price relative to the CPI, create a ratio of that. That can give you kind of an idea of um, how gold has performed in terms of goods inflation. So CPI is a measure of the basket of goods, um, and how the prices of those change on a monthly basis. But if you kind of go back to 1970 and that set that index to 1, right now it's at about 6. So it's at a level of 6. So gold price has increased sixfold relative to inflation. So as it one say that has gold held its value under inflation over the last 50 years, and it more than has in relative to goods inflation. But if you were to look at gold price relative to the S&P, or relative to even like real estate, the S&P's returned over 10% since 1970 on an annualized basis, and even higher than that since the turn of the millennia. Um, and gold is just not in, and that's outpaced the appreciation of gold, or the annualized return of gold prices too over that period. So yeah, it hasn't kept pace with inflation. Yes, but relative to other assets, like the S&P, or real estate, not as much.
So in terms of an inflation hedge, it wouldn't be something everyone would be falling to get because it is, I mean, it does return better, but it's not as good as some other hard assets or
Correct.
equities. Okay.
Correct. Yeah.
So where do you see like gold's at 1750? I guess for our viewers, what are the uncertainties that could drive gold forward, like higher, or that could give us a little bit more, downside risk?
Well, again, that the Fed meeting, I think they're going to be halting this or diminishing the asset buying that they have been doing. We could see some tapering in that area. Higher interest rates probably to come. So that would be again back to our initial discussion on real interest rates. You're going to see higher interest rates, and that's a negative influence on the gold price.
But don't you think that's potentially already embedded since what he said last week that the market's anticipating higher rates now in November?
Yeah, but again, that to what degree that happens, you could see, what pace does the Fed do this? Is it going to be sooner than, right now, you get those Fed statements and it's kind of indicative, but it's not definitive in terms of the amount and the dates of this of their pending actions. When that becomes much more of a reality, you could see some, our interest rates going to be climbing higher than anticipated right now. So there's still some uncertainty with the timing and the amount and how that relates to gold. You know,
I,
could be further negative pressure on the gold price.
I think the Fed, to a certain extent, has been hedging its bets with its statements because it's kind of saying we might do, we might not. It's trying to keep its options open, but without being committal. So, trying to keep everybody guessing to a certain extent, so it can move in either direction or do nothing, depending upon how the reality of the economic situation continues to unfold.
Yeah, you just, here we are in a pandemic. We've kind of been through the initial wave, the second wave with, this Delta variant, how that progresses. Do we get, more variants that causes economic disruption? The Fed is just still kind of just walking on the fence, so to speak, until a little bit more clarity would occur, I imagine.
So what I've noticed, and I've been as you have tracking real rates versus the gold price, and there's not a direct correlation, but there's trends. And what I've also noticed is it's not the absolute number of the real interest rate that really pushes people to invest in gold or buy the ETFs and things like that. It's the trend. So if you're going from a positive number, let's say you're going from positive 0.6% to negative 0.6%, then it seems like the gold price will spike. But if you're going from, let's say, negative 1% to negative 0.6%, gold price will drop because the idea is that the trend is not your friend, that the rates are rising. And so for me, it's not the absolute number. You can't take, oh, it's negative 0.6%, so gold is very attractive. It's those people that are looking ahead, like your BlackRocks and that, and saying, oh, well, that negative 0.6 is going to go to 0 or go to 0.5 positive or 1. That's really the issue right now. And so do you follow those kind of changes?
The momentum pieces definitely, it's definitely a factor when you talk about that investment side of the gold market. There is that, but yes, the trend is definitely an indication when it comes to real interest rates. And honestly, it's a pretty strong correlation when you think about it. Since the millennia, that it's a negative nearly 90% correlation between real interest rates and gold. So it's very strong. And if I had to rank indicators factors that drive the gold market, it's going to be real interest rates and the dollar. And you could probably get down to some other things, central bank demand after that, and liquidity measures, how much liquidity continues to be pumped into not only here in the US, but globally into economies as some of the other factors.
So to just basically get the negative and the positive with gold is basically it'll all be driven by the Fed moves and the implications on the real rates, which drive the ETF investment demand in gold. Whether that comes back to the market, whether the BlackRocks and the institutional funds come back based on
Yeah.
that, or they continue to retreat.
Yeah. So, when you think about, global ETF uh, um, holdings, that climbed to, over 111 million ounces, an all-time high last year. Again, back in August. This year you've seen some liquidations going on, primarily driven, by investors here in the U.S. in North America, probably U.S. Canada. And that, nearly 5 million of those ounces have been liquidated. And that's, there's a strong correlation again with ETF holdings and the gold price. So
To a
So,
certain
and that's
extent,
not going to.
have ETFs become sort of like the sort of marginal buying of gold that sort of really moves the price, the
yeah,
marginal
in the
factor?
near term, it's definitely going to be that investment demand. Another thing, you're always going to, well, what about geopolitical risks? Geopolitical risks are pretty transitory. They will spike up the gold market. Say if there's a heightened issue with a trade war between the U.S. and China. That's probably going to spike up the gold price to a degree, but that tends to filter relatively quickly through the market.
Do you see like a ephemeral like an event was it Evergrande Evergrande the Chinese developers did that contagion potential, do you think that would have any impact on the gold price?
As far as when you think about on the physical demand side of the gold equation, jewelry in particular, that typically makes up about half of annual gold demand. And most of that is going into either India or China. So from that point of view, if there's less disposable income, so to speak, in that country, you might see it weighing down on the physical demand side of Chinese, jewelry. But then again, do you start to see that, the millennial sector in China, they would look at gold jewelry as, oh, that's just stuff my grandparents and my grandma buys. I don't buy that. I want I've been putting my money into real estate or whatever. But do you see that trend reversing a bit if this real estate sector starts to, this bubble that's been created over the last 15 plus years in China start to pop, and all of a sudden real estate is not the slot machine that always wins in China anymore.
But would that impact safe haven demand globally for gold?
I at this point, Joe, I don't see it spreading that real estate financial sector contagion spreading over to the US.
Okay.
So
Like there's not a lot of US firms with ties to that.
exactly.
Right.
Right.
Okay. But would it impact people? I mean, because there are ties in Asia and in other places there, and Asian demand for gold or safe haven, uh, you know, could increase if that's something they see. I know some people would be affected by disposable income, but by others might be impacted by saying, okay, I'm going to take my money out of equities and put it into gold.
Um, again, that could, it's one of those factors. Do you see it? Do you see the younger investor have interest in China into gold? Do you see people pulling money out and putting it into gold? Yes, that could definitely happen. Say, for example, in India, though, most of that jewelry demand is going to be in the rural / agrarian parts of the country. Most of that demand is going to be rural farmers. There's not a lot of confidence in the banking sector over in India, particularly, and limited access to the banking sector, particularly in many of the poorer parts of the country. So you still see that strong demand for gold, and I don't see that getting disrupted by, for example, a shakeup in the real estate market in China.
So, I mean, before you started working at the J.P. Morgan Center of Commodities at the University of Colorado in Boulder, you worked as the
Denver.
chief. Denver. Oh,
That's a
sorry.
big, when you get into this university environment, that's a big deal between CU Boulder and CU Denver. Don't
Okay.
ask me why, but
Sorry.
not a
Okay.
problem.
Hopefully, we won't be chased by Reddit people because of that. We've already been banned from China, so let's hope nothing happens to us in Colorado. But yeah, so you worked obviously in industry, like we worked together at Newmont. You rose up to be the chief economist. So you're sitting there, gold price 1750. And you were there before when gold was hitting 1960 in the previous peak in gold while you were with Newmont. And at that time, most gold companies weren't in such good shape. Dilutive M&A, big debt, higher gold price assumptions driving their reserve bases. But right now, the Newmonts and the Barricks are using 1200 and 1250 to drive, their reserves. And they basically cleaned up a lot of their debt. They're paying higher dividends, which makes them potentially more attractive than the ETFs, the equity ETFs. So just in terms of your previous history in the industry, where do you see the gold industry right now in terms of its health versus the last time we had a peak or,
Yeah. When we were working together, Joe, it was that growth at any cost mindset. I'm producing 5 million ounces this year. In 5 or 6 years' time, I'm going to be producing 8.
Yeah.
Top line growth, any cost, doesn't matter. Throw the whole kitchen sink when it comes to all your assets, pipeline, all your project pipeline, throw everything in there. Let's see what we can develop. And, we were at the corporate headquarters of Newmont, and we went from, around that 200 employees to, close to 1,000 when you put in some contractors. Just incredible headcount. Cost, again, cost is no object. At that time, you also saw a lot of CEOs coming out of the CFO rank. And I just remember the headline. It's like, finally, we have some business people running these stodgy old mining companies. And, when that bubble popped in 2011-12 period and gold retreated significantly, you really saw just big shakeups in management teams and CEOs coming out of the COO office, much more disciplined, focused, and we are keeping a lid on things. And the industry has kept with that so far. You haven't seen a lot of, again, we're just blowing ourselves up on big M&As. And we just have to add to that top line. So you haven't seen that. So much more financially sound than it was back in that 2011-12 period.
So our flat production, I remember before, we were always talking about 3 to 5% production growth over 5 years, but now, Barrick is showing a 10-year, plan of production, which basically flat, and to your point, now it's more about free cash flow. It's more about dividends, and that's being driven by the generalist investor. But if the general investor is no longer interested in gold and starts pulling out of the sector, what you're left with is maybe the resource funds that actually start asking for growth again. So do you think that, you think that that's going to change it, that suddenly, oh, now I do want growth because now I'm running the show?
Well, I hope it doesn't come back to the way it did back in that 2008 plus period, because it really was incredibly value destructive. Just, when you think about the gold seniors, equity climbed, by, I think it was a fourfold increase in equity issue, equity outstanding,
Yeah.
shares outstanding. Debt outstanding was up 700%. So it was just, and if you're an investor in that, you're really just getting diluted, and your value it's been value destructive. So I really hope that the growth mindset doesn't return to the gold sector.
Growth in production, but maybe
Growth in
free cash
production.
flow.
Sorry, growth in production.
Yeah, go ahead, Paul.
One sort of data point to put on that, Metals Focus out of the UK recently put out a report, and in that they said net debt in the senior gold sector has fallen from about 32 billion, I think 10 years ago, to about 6 billion now. So obviously, as Joe mentioned, and you mentioned, Tom, a lot of balance sheet repair and a lot of running businesses as businesses.
Right.
Yeah, and technically, to Tom's point, running better operations where the CFO might not have realized the kind of assets they had, whereas a CEO that was formerly running the operations as COO has a better handle on what each asset can actually do. And I think technically that's probably the way you want to do, because besides the gold or the commodity risk and the FX risk, foreign exchange risk, the assets are most important, and the capital blowouts before were a big issue. So Tom, I think we could wrap it up there. Thanks very much for joining us. And Paul, you got any wrap up questions or summary?
No, I think that was a very educational conversation, especially for me. I'm more familiar with the stocks rather than the sort of mechanics of the gold sector. So I learned a lot, Tom. Thank you very much. As you probably saw, I was scribbling notes down as the conversation developed. But as Joe said, unfortunately, that's all we've got time for today. So thank you very much for joining us. And for everybody else, stay tuned for more from Joe and Paul's Another Mining Podcast.